Hello everyone, welcome back to our channel. This is Vaibhav Bansal. Today we are going to revise the double taxation relief chapter in details. The in Hindi audience, I have already uploaded the video yesterday on my Hindi channel, the Vaibhav Bansal channel. The link of the description is given in the description box. If you want the lecture in Hindi, you can check that description box link. This video is wholly dedicated to the English audience, English viewers only, the double taxation relief. Let's start with that. See what we are going to do in this chapter first. We are going to do first the introduction of the double taxation relief, then some few concepts is given under the relief chapter, the bilateral relief and the unilateral relief. We'll just go through once what these types of reliefs are, what are the objectives, how it be taxed, and some few other things as well. Then there is a computation of relief that is going to be asked in ICI examination. This chapter is a short 6 marks question chapter that you'll definitely get in your examination for 6 marks. So this chapter becomes ultra very important to do with utmost carefully. Now we'll solve the questions of the double taxation reliefs as well. I have identified 9 to 10 questions which you have to do, not more than that. There is approximately 29 questions in my question bank, but you do not need to do every question, as all questions are more or less the same. The few adjustments which are changed, I have tried to solve those adjustment in this video itself. So no need to do every question if you have a short time. If you are giving only the group 2 and having the DT having some crunches in the DT, then you can definitely solve each and every question. And if you have any doubt in any question, you can ask me in the comment section or in the Telegram group. The Telegram group link is in the description box. If you also want to join the WhatsApp channel is also available in the description box as well. So without any waste of time, let's start with the double taxation relief chapter. See, as the name suggests, double taxation relief. Relief from the double taxation. What is double taxation? Double taxation is a term used when a income is charged to tax twice. When an income is charged or subject to tax twice, that is called a double taxation. See, double taxation means taxing the same income twice in the hands of the assessee. Then how many types of rules available to give the relief from that double taxation? So there are basically two rules available in our society. First is the source rule and second is the residence rule. On these basis, the countries charge the tax income to their taxes. See, the source rule and the residence rules. What these rules says? Source rule says the income will be charged to that country in which the income is earned. I repeat, source rule said the income should be charged to that country in which the income is earned. So the income tax in the country in which it originates, irrespective of whether the income accrue or arise to a resident or non-resident. It does not matter whether it is a resident or a non-resident. If the income arises in your country, then you have the right to tax that income. This says the source rule. Now come on to the residence rule. Residence rule says simply that if the assessee is your resident, then you have the full right to tax that income, which is earned by that assessee, which is resident in your country. So the resident rule says that if a assessee is your resident in your country, then you have the full right to tax the income of that assessee in your country. See, income tax in the country in which the taxpayer is resident. If you are a resident, then the country gets the right to tax your income. Now to focus on, here it is written the resident. Do not confuse it with ROR or RNOR, resident and ordinary resident and resident not ordinary resident. This is not relevant for this. You have to just check whether he is a resident or not resident, non-resident. You do not need to check the additional conditions. Okay, in few questions you'll need to check, but why you need to check, I'll show you in the question itself. Okay, now let's move on to the relief portion. Now we have understood the double taxation part. Now we have to understand the relief portion. As the chapter suggests, double taxation relief. Relief from the double taxation. We have understood the double taxation introduction. What is a double taxation? Why it is given? Why this relief is given? In order to avoid such double taxation avoidance agreement comes into play. You have already studied or might be studying the Model Tax Convention in your chapter, in your syllabus. Model Tax Convention. There are two types of conventions, the OECD model and a UN model that you need to study. There are other models as well as the US model, but in your syllabus, the OECD and UN model is available. So the DTAA comes into play where it avoids the double taxation or gives the right to the taxing country to tax the income of such resident. Is it clear till now? Now, come on to the relief portion. The relief is given under the two way, the bilateral relief and the unilateral relief. Bilateral relief comes into play when there is a double taxation avoidance agreement between the two countries. Then it is a bilateral. When there is a bilateral agreement, when there is a bilateral relief, when there is an agreement between the two countries. See, the agreement with the foreign countries or the specified territories. Some specified territories are also notified by the CBDT that we do not need to study here. Okay, the bilateral relief is clear. Now, the unilateral relief. Unilateral relief is the relief when there is no DTAA between the two countries and the resident country is giving the relief to their resident to avoid the double taxation. I repeat, unilateral relief is the relief given by the resident country itself when there is a no agreement between the two countries of the double taxation avoidance. Then such relief is called as unilateral relief. Countries with no agreement exist is known as the unilateral relief. You can remember the section number of unilateral relief by unilateral is single person, then it's one. 91 is the unilateral relief. Bilateral relief section number 90 is used to be learned by every person. They remember the bilateral relief section number, but they forgot the unilateral relief section number. So section number 91, one is a unilateral person, is a single person, that is unilateral relief. The section number, I hope you get remembered the section number as well. Now, what is the objective of the bilateral relief? So, see, the objective of the bilateral reliefs are very easy. See, the central government may enter into an agreement with the government of any country outside India or the specified territory or specified association outside India. The central government may enter the agreement between the country other than India, a specified territory, or the specified association outside India. For what objectives? Now, these are the objectives. Club these objectives between the 2 points. Okay. Now, the first part says for granting of relief in respect of the doubly taxed income. That was the chapter. That what the chapter indicates as well, the double taxation relief. We want to give relief from the double taxed income. That is the objective, the objective number one, which used to be clear with you. Okay, this is clear. No. For the avoidance of double tax of income without creating opportunities for non taxation or reduced taxation through tax evasion or avoidance. What does it says? The DTAA is entered with the objective that the assessee, should not route the transaction as such that the non-taxation opportunities creates. That the person routes the transaction as in such way the income is also exempt in our country and the same income also gets exempt in another country as well. So the DTAA ensures that the tax should be levied either of the country by either of the country. There should not be any opportunity for non taxation. Either of the country should take tax from that income as well. So this is the core objective of DTAA. The second part of the DTAA objective is for exchange of information for the prevention of evasion or avoidance of income tax through the DTAA, through the bilateral agreement. It says we can exchange the information of our assessee if is of use by the other country as well. If suppose, if um if there is a citizen of India paying tax in India as well, okay, the same citizen is resident of US paying tax as well there. Now the citizen in the Indian country wants some information from the US country for that assessing, either to conduct any assessment or anything which is of need for the department. Okay, so they can ask from the US to exchange the information of that assessee so that they can conduct the assessment or any other procedure which they wish to do. So the main objective for the DTAA is to also get the information exchange from the country to country. This is clear. Now, why they are exchanging the information for the assessment procedure so that they can get the revenue if the tax evasion has been done. So the next and the last objective for the DTAA comes into play for recovery of income tax. Why it is given? For exchange of information for the prevention of evasion or avoidance of income tax, for recovery of income tax. Okay, it is clear. So these are the 4 points that you have to write in your examination when this questions comes. What are the objectives of the bilateral relief or the DTAA? This is the 4 marker question, not more than that. ICI may ask this question 1 or 2 times. It has been asked. This question has been asked as well. So you have to read this question only. Just if you get read this question, you will understand that easily. Okay. Now come on to the taxability part. Taxability of income would be determined based on the DTAA or the Income Tax Act 1961, which is more beneficial to the assessee. To the assessee, right here, to the assessee. See these notes, the question bank is already been uploaded on the Telegram channel. The link of the Telegram channel is given in the description box. So if you want to download those and take and wanted to take printout of these notes, you can do so very easily. Just go to the description box, join our Telegram channel. You will find these notes available. Okay, if you can check the file section as well, it will be available in that only. Okay, now what the taxability says? Taxability says, say, for such income, suppose for royalty income tax says to charge at 20%. But the DTAA between the two countries says the royalty income will be charged at the rate of 10%. So whichever is more beneficial to the assessee, the 10% is more beneficial to the assessee. So the DTAA will prevail over the income tax act. So the taxability is charged on that basis. The determination of the determination should be based on the DTAA or the Income Tax Act 1961, whichever is more beneficial to the assessee. Is it clear? Clear. Now, the charge of tax on foreign company. See, if you remember, so the domestic company tax rates are 15%, 22%, 25%, or 30%. But for the foreign company, the tax rate are flat 40%. So the foreign company says there is a disproportionate of taxation, that you are charging the domestic company by the rate of 30% and the foreign company at the rate of 40%, that is creating a less favorable treatment to us in India. As the DTAA says that the DTAA says by a clause in that says the country should not do any less favorable charge to other countries, like to other companies, like in the domestic company the tax rates are other and the foreign companies the tax rates are other. So there is a less favorable treatment to the domestic to the foreign companies. So the India has to clearly mention that the charge of tax that is the 30% or 40% in respect of the foreign company at a rate higher than the rate at which the domestic company is chargeable. Higher at the rate, the 30% is lower than the 40%. So the foreign company at a rate higher than the rate at a domestic company is chargeable shall not be regarded as a less favorable charge or levy of tax in respect of such foreign company. It is not a less favorable charge or levy for such foreign company. Why the government says that? Government says that this is a base rate. But what we take surcharge for, surcharge rates are 7 or 12% to the domestic companies, and for the foreign companies the surcharge rates are 2 or 5% only. So we are giving here the favorable charge to you. So the less favorable charge on the base tax does not be entertained, will not be entertained as a less favorable charge or levy in such respect. Okay, now to claim the TTAA benefit, you should produce any document that you are a resident of such other country so that we can give the claim of relief to you. So the government says the tax residency certificate should be made available by the assessee to the department. On such basis only the tax department will give you the relief of such taxed income in other country. So in order to claim double taxation relief, the NR to whom such DTAA applies has to obtain a TRC from the government that country or specified country. The NR to also provide such other document and the information as may be prescribed for claiming from claiming the treaty benefits. Such other documents that may be prescribed by the CBDT in India and the other department, revenue department in other countries, they will prescribe such other documents that you need to submit to the tax department so that you can get the double taxation relief. This is the whole provision of the bilateral relief. I hope this is clear to you. Okay. Now let's move on to the unilateral relief. Unilateral relief, as I said, the countries with which no agreement exists, the unilateral relief comes into play to rescue the assessee's double taxed income. Okay, is this clear? Now, what is the applicability? As I have already said earlier in the definition, that this is given to the resident of India during the previous year. If you are not non-resident, so we do not care about you. We only care about the resident in India during the previous year. Okay, who is resident in India during the previous year? That will only cover under the unilateral relief. The tax department will only give the relief to those who are resident in India during the previous year. Now, what are the conditions to claim these benefit the unilateral relief? These are the very basic conditions. You just need to read this. You do not need to remember any of the condition. Just remember one point: the objective of the bilateral relief, the four marker question. But for the conditions, you just need to refer it once and just leave that. You do not need to you do not need to cram these conditions or remember these conditions. These are the very basic conditions. The first condition is the income accrue or arise to him outside India, then only it will be taxable in India. If you are a resident, if the income accrue or arises in other country, then it will be taxed in the other country as well, and India as well. As you are a resident, if you become the ordinary resident as well, then the global income is taxed. The global income comes into the nexus, then the income accrue or arises to him outside India will be taxed in the other country as well and in India as well. So the first condition for the unilateral relief is that the income should accrue or arise outside India. The income is not deemed to accrue or arise in India during the previous year. The income should not be deemed to accrue or arise in India during the previous year. Okay. The income in question has been subjected to income tax in foreign country in the hands of the assessee. This is the basic condition. The income should be subjected to tax in the foreign country in the hands of the assessee. Should be subjected to tax. The tax should be levied on that income, then only we are going to give the relief. If the income is not taxed in other country, then what type of relief you are seeking? You can only seek the relief when you get twice, when you tax twice. So the income should be taxed in the foreign country as well. First, the income should be taxed. Secondly, the tax should have been paid to the other country. The assessee has paid the tax on the income in the foreign country. Is this clear? The tax should have been paid. If the tax is not paid, it is showing the payable, then the unilateral relief will not be available to you. See, and this is the very basic condition that we already studied here. When there is a no agreement, then only the unilateral relief will come into play. Now, this is the same thing. There is no agreement for relief between the from double taxation between India and any other country where the income has accrued or arisen. This is a very basic condition. So these are the very basic condition. You just need to refer it once and leave that. Okay. Now this comes to the main part. The part is the computation of relief. This is the main calculation in the whole chapter. You will get the 6 marker question from this part only. You have to calculate the relief portion and the net tax liability. Is it clear? Now, see, leave this paragraph as of now. I'll make you understand by the exam. See, if the income of India, the income of the assessee comes to 15 lakh. Okay. Just suppose the tax is 4 lakh. After all the deductions and all, the tax becomes 4 lakh. Okay. Now we have to calculate the average rate of tax in India. How will it come? Just the average, as we calculate the average, this needs to be calculated like 4 lakh tax paid on the 15 lakh income multiplied by 100 is equal to 26.67%. Am I clear? No. Now you have to calculate the average rate of tax in any other country. Okay. Suppose the average rate of tax in any other country from which the income accrue or arise for that assessee comes to 16%. Am I clear? So whichever is lower, like 16%. This is the only double taxed income that the double tax is of 16% only. The excess is charged by India itself. So the what is the double tax? From the 26, this is the whole 26.67%. The 16% mark is only charged by the other country as well. Sorry. This is the excess portion which is charged only by India. So this is not the double taxed income. So the double taxed income is only the double taxation rate is only the 16% on which the India also charged and the other country also charged. So the government want to give the relief of that double taxed only. So the 16%, that's why we choose the 16%, the whichever is lower. So the 16% will get the double tax in, relief. So now, suppose the double taxed income, the double tax income is 5 lakh. Okay. Now you have to apply the 16% rate on that 5 lakh. Now you will get 80,000 as the tax paid on the double tax relief on double tax income. How we calculate the double tax income? It will be shown in the questions itself. Okay. Double tax relief from double tax income. Now you have to reduce this relief from the total tax payable in India. Suppose the total tax payable becomes 12 lakh. Now you have to give the relief under section 91 of 80,000, which we have calculated here. Now the total tax payable becomes 11 lakh 20,000 in India. Is this clear? This is the whole provision. I have made you clear the whole provision. See, double tax income multiply by this. What is this? Indian rate of tax or rate of tax in the said country, that is the other country, whichever is lower. This is what we give. The double tax income 5 lakh multiplied by the 16%, that is the whichever is lower, 16% or 26.67%. This is the whole computation of relief. Just I am showing you a steps, 7 steps that you need to remember while solving these questions. See, step number 1. You have to calculate the total income in India, including other income. If other countries, if you are a resident and ordinary resident, then the global income will be taxable to you. So for the sake of solving this question, for the sake of calculating the total income, you have to include the other countries' income as well. Then, step 2, calculate tax on the total income till these cess, including cess. You have to add the surcharge as well. You have to add the cess. The final tax you have to calculate here. Okay. Then, step 3, calculate the average rate of tax in India. Average rate of tax will be the tax on total income divided by total income multiplied by 100. This is the average rate of tax. See, most of the times, average rate of tax for foreign company is given. But if sometimes not given, then we have to calculate with the same formula in step 4. Step 3. Repeat it. Step 3. See, most of the times the average rate of tax for the foreign company is given in the question, but if sometimes they do not give, then we have to calculate the average rate of tax in the same manner. The formula will remain the same. Just the here the total income will only be of the country in which the in which the say said income is accrue or arise. Okay, this is clear. Now, come on to the point number 4, the step number 4. After getting the average rate, you have to calculate the double taxed income, the income which is taxed twice. I repeat, the income which is taxed twice, not the income which is earned in other countries. In the other countries, here we can see the double taxed income, the income on which the other country and India has taken tax. Okay, now step number 5. Compare the average rate of tax in India versus the average rate of tax outside India, whichever is lower. In the step 5, identify which rate is lower. The step 6, the step 4 multiplied by step 5 means the double tax income multiplied by the rate whichever is lower. This will get you the relief. What is the total tax relief which you are getting? The step number 7, the last and the final stage, that the tax calculated above under the step number 2, you have to reduce that tax by the relief that you have calculated in the step 6. That will give you the final answer, that will give you the final tax liability, the net tax liability to be paid by the assessee in India. These are the 7 steps that you need to follow while solving all the questions, and you have to also focus on whether the assessee has taken the benefit of the new tax regime or the old tax regime. You have to also check that, because in the new tax regime we do not get the deductions of the deduction from chapter 6A. Then you have to calculate that from that way. So you have to calculate, you have to see that carefully whether the assessee has opted for the old tax regime or has undergo with the default tax regime under section 115 BAC. These are the 7 steps that you need to know. If you want to take a screenshot of these notes, then you can take that. I'm pausing for a minute. You can take that screenshot. I hope you have taken the screenshot. Now we are moving towards the question and answers of the double taxation relief. The concept portion is completed. Now we are going to move to the solving of the double taxation relief question. We are solving the 8 to 9 questions that are very important, and the most importantly, this is the May 24 examination question. The question number 3, part B. This you will solve and send me the answer in the comment box or in the Telegram group with the if you want, if you can share, then you can share the screenshot as well for your solved answer. Otherwise you can share the answer as well. Okay, this is your homework. You'll find this question very easy if we solve all these questions, all 8 to 9 questions. So this is the homework. If you want to take a screenshot of this, you can take, though otherwise I'll make you take the screenshot at the end of the session. Okay, now I have marked only 8 to 9 questions that we need to solve. Just other questions are very easy and very basic. You just have to give a read. You will solve everything. Just come to the question number 5 now. See, we'll read the question very easily, very smoothly, in a very slow manner. Because if you read the question very easily, if you read the question very carefully, then the answer comes very quickly. So just understand the question very normally, very smoothly, very carefully. Okay. Now we are moving. Mr. Naveen, a individual resident in India, aged 52 years. Aged 52 years means he is a normal citizen. The senior citizen should benefit should not be given to this individual. The royalty income of 15 lakhs from XYINC of Canada for writing articles in journal and newspaper for the year ended 31st March 2024. However, he received only 12.50 lakhs during the previous year 23-24 and the balance is outstanding as on 31st March 24. Okay, so he only received the 12.5 lakh out of 15 lakhs. He maintains the cash system of accounting for royalty income. He maintains the cash system. If he maintains the cash system, so the income will only be the 12.50 lakh which he has received. So the 15 lakh is of no use. The income will take for this question will be 12.50 lakhs only. But now see, if you have remembered, so the royalty income gets a deduction of rupees 3 lakh. If you remember the deduction chapter, the royalty income gets a deduction of 3 lakhs. With some prescribed condition, if those conditions are fulfilled, you will get the deduction of 3 lakhs. But here we are assuming the conditions are fulfilled if nothing is given. But there is a point. The deduction will only be given when the royalty is earned for writing a book. For writing a book. I am writing here for writing a book. But in this, the general journals and newspapers are given. So the deduction under for the royalty of rupees 3 lakhs shall not be given in this case. Okay, this is clear? Clear. Now, he also earned a rental income of 2.40 lakhs gross from a house situated in Canada. Municipal taxes paid in respect of the house amounted to rupees 10,000, which is not allowed as deduction in Canada. The municipal taxes paid deduction is not allowed in Canada, but it is allowed in India. So we'll take as we are calculating the tax as per Indian rules. Okay. DTAA between India and Canada provides a tax at the rate of 15% in India without prejudice to taxation of the same income in India. Okay, what is given? The average tax rate of Canada is given, that is 15%. So you do not need to calculate the average rate of tax in this step 3 for the other country, as written in the red color. The most of the times the average rate of the tax for the foreign company is given. Is this clear to you? Clear. Let's move forward. He further received 3.5 lakh during the year as dividend from income from an Indian company, X Limited from an Indian company. Now you have to focus on one word. He further received. If he has received 3.5 lakh, so the gross amount should be higher than 3.5 lakh, as because the tax has been deducted before releasing the dividend to the by the company. So the tax rate is 10%, that to be charged on the dividend income. So the company has deducted the TDS of that on that income. The net figure of 3.5 lakh is to be received by the assessee. So the word here is received, so we are taking it net. We are taking it net. It is not grossed, as the word received is written. See, so what we do, 3.50 divided by 90%, and it is a 90% only. So what will be the 100% portion? From this we'll get the dividend income of that assessee, Mr. Naveen. Now let's move forward. He took a education loan from the bank for his son who was pursuing MBA. Annual repayment of loan and interest amounted to 1.20 lakhs and 0.24 lakhs respectively. Is this clear? So the interest amount deduction of 0.24 lakh shall be made available under section 80E E for education. Is this clear? E for education. Is this clear? The 0.24 lakhs deduction will be available to that assessee under section 80A. Compute the total income and the tax liability of Mr. Naveen in India for the assessment year 24-25, assuming that he shifted out to the of the default tax regime under section 115 BSE. So he wants to get tax as per the old regime. Is this clear? The question is clear or crystal clear? The question is crystal clear now. Okay. Mostly the question we have solved while reading itself. Now just follow the step which I have said. The first step, if you see, first step is the total income in India, including the other countries' income. Just come. Mr. Naveen firstly get the income from the Canada for royalty income. It is a PGBP income. Okay. It is a PGBP income. Then it is a house property income. So first head is a house property head. Let's move on to the house property head as the salary head is not available. So the house property head. The gross income is 2.40 lakhs. The deduction of 10,000 is to be given in India. So the net annual value is equal to 2.30 lakhs. From this, we have to give the standard deduction under section 24A, that is at the rate of 30%. So give that 2000 2 lakh 30,000 minus 30% will give you 1,61,000 as the income from house property. Is this clear to you? Okay. Now come to the PGBP point. PGBP. He get 12.50 lakhs. So PGBP will be 12.50 lakhs. Now come to other source income. Other source income is the dividend income. We have completed this paragraph. We have completed this paragraph. Now we come to the paragraph number 3. He received 3.50 lakhs rupees as dividend. So then 3.50 divided by 90% multiplied by 100% is equal to, we get 50,000 divided by 90%, we get the income of 388,889 rupees. So the total income we get, gross total income, is the summation of PGBP, other sources, and the income from house property. So we do that. 12,50,000 plus 388,889 plus 1,61,000 will come to 7,117,99,889. We do, let's reduce. First, let's reduce the deductions under under chapter 6, 6A. What are the deductions? If you see, we do not get deduction for the royalty income. We do not get deduction from the house property income. We do not get the deduction from the dividend income. So the only deduction we'll get under the section 80E, 80E of 24,000. Okay, minus 24,000, we'll get 1775889. We'll do the round off under section 288A. That will come to 1775,890. Is this clear? 1775,890. If we check the answer, 1775,890. Is this clear to you? Clear. Now we have to calculate the tax on this. Tax to be calculated on the old regime. So if we calculate the tax, the 17,75,890 minus 10 lakh multiplied by 30% plus 11250 plus 4%. We have added the surcharge as well. So the tax will come 35907, you can say 78. Okay, 35, see, 359078, 359078. Is this clear to you? Clear. Okay. Now, what is the third step? See, We have completed the step number 1. We have completed the step number 2. Now we have to calculate the average rate of tax in India. Step number 3. Okay. Step number 3. Average rate of tax in India. This is the first question. That's why I'm solving each and every point of this question. Otherwise, onwards. Otherwise, from this question onwards, you will able to solve each question by yourself. The main important point I'll let you know. The average rate of tax in India will be 359078 divided by 1775,890 multiplied by 100 is what we get. 359078 divided by 17,75,890 multiplied by 100, we get 20.21 or 220%. Take as a three figure after the decimal, take the three figures. Okay, 2.220. We get the 2.220 here as well. Okay, now come on to the step number 4. What is the step number 4? Step number 4 is to take the double taxed income. What is the double taxed income? See, the income which get the double tax is the only income which is earned in other country. So the income earned in the other countries are two: the income of royalty, the 12.5 lakh, which is charged here as well in the other country as well. Eh? And the Canadian income of rental income of will be taxed at the rate of 15%. Okay. So the double taxed income will be firstly the royalty income, 12 lakh 50,000. We do not get any deduction from it under section 80 QQB. So here we are not reducing that deduction. But for house property, out of the gross value, the 2,40,000, we Indians only charged 1,61,000 to the tax. Either we have given the deduction of 10,000 of the municipal taxes, and we have also given the standard deduction. So what we have charged is only 1,61,000. So the only portion which is taxed twice is 1,61,000. So here we only add 1,61,000. Then the income comes to 12,50,000 plus 1,61,000 will come to 14,11,000. This is the double taxed income. This we have completed the step 4. Now comes to step 5. What is the step 5? Step 5 is to check the rate, compare the rate, average rate of tax in India and the average rate of tax to other countries. Now when we compare rates, we find the Indian rate is 20.220, but the Canadian rate is only 15%. Okay, so the comparison is whichever is lower is 15%. Now come to step 6. The step 4 multiply by step number 5, that is 14 lakh 11,000 multiplied by 15%, we get the relief amount. 2,11,650 is the relief amount. Now we have to calculate the final tax liability, which is step 2. The tax which we have computed under the step number 2, 3 lakh 359078 minus step 6, the relief portion. 359078 minus 211650, we get 359078. We get the final tax liability of 147,428. When we round it off, 147,430 is the final tax amount under section 288B. The round off is done under section 288B. The final tax liability is 147,430. See this. 147,430, 147,430. Is this clear to you? We have just solved this question under the 7 steps only. Step 1 is to calculate the income, total income. Step 2 is to calculate the tax. Step 3 is to calculate the average rate of tax in India. Step 4 is to calculate the double taxed income. Step 5 is to compare the average rate of tax in India and the other country. Step 6 is to find the relief by multiplying the step 2 and step 5. Then step 7 is to get the final tax liability by subtracting the step 6 from the step 2, which we have calculated earlier, the tax liability. This is the whole question that we need to understand. Is this clear to you? Clear. If you have any doubt in this question, just back the video and see it again. It is a very easy point. You do not need to worry about this question, as we are going to do the much tougher question in the coming video, in the coming questions. So this is a very basic questions. You will not need to do it again when you solve all the questions which I am going to solve here. Okay, this is a very easy question. I just marked it because it is just a first question. So I took it a easy question. Okay, this is the question number 5. Done. Come on to the question number 6. Before coming to the question number 6, I want you to understand some few concepts that I have given here. The rule number 128 and rule number 115. These are the rules which we apply to convert the income or tax into from the foreign currency to Indian currency. Okay. Rule 115 is to be applied when income needs to be converted from foreign currency to Indian currency, and rule number 128 needs to be applied when the tax to be converted from the foreign currency to Indian currency. Is this clear? Rule number 115, when to apply, when we need to convert the income, and when rule number 128 applies, when we need to convert the tax paid in the other country. Is this clear? So the rule number 115 says income in the foreign currency converted in INR at TTBR of SBI on a specified date. What is the TTBR? TTBR is a rate, the telegraphic transfer buying rate. It is a rate given by the SBI. So we have to calculate that from that rate on the specified date. Now, what is the specified rate? So the CBDT under section rule number 115 has clarified that for the salary income, income from securities, dividend, shipping business, and capital gain. These are the 5 types of income that to be converted on the from the rate on the last day of the month of the preceding previous month or the immediately preceding month. Suppose the salary is earned on 31st March 2024. Okay. So the immediately preceding month is the February 2024. The last day of February 24 is 29th. So we have to take the TTBR of SBI on the date of 29th February 2024. Is this clear? The last day of the immediately preceding month. Okay. Now, for the house property or any other type of income, remember the house property and any other type of income, you will have to calculate the last day of the previous year, which is the 31st March 2024. Is this clear to you? The last day of the previous year. Okay. The rule number 128 says the same thing, says when you have to convert the tax from the foreign currency to Indian currency, you have to convert at the rate TTBR of SBI on last day of month immediately preceding month in which the tax was paid. Same example as above. The salary, interest on securities, dividend, shipping business, and capital gains. Okay, for this chapter, you will get the question from the salary, and you will get the question of the house property income. So these two income becomes important to understand. Let me correct it. House property income and the salary income will be the question you will getting. So the salary will be converted from the rate TTBR of SBI last day of the immediately preceding month, and for the house property, last day of previous year needs to be taken care of. For the taxes paid, last day of the immediately preceding month to be taken. Is this clear to you? If you want to take a screenshot of this, take a screenshot for the further purpose of this video itself, because for the future references, this PDF is already shared in the Telegram channel, so you can check from that and take the printout of that portion. So for now, as of now, for solving the questions, if you want to take this screenshot, just take it down. Okay. Shall we move forward? Okay. Now come on to the question number 6. Read it very carefully. Mr. Ritesh, a resident individual aged 42 years and the following sums during the 23-24. Income from business is 4,85,000. Royalty income is from country N is 7,80,000. Country N rate is tax 10% and the tax deducted at 78,000. It is given. The rate is also given. The average rate of tax is given. Okay. Interest other than interest on securities. Now see, I have shown you interest on security is to be converted from the last day of the immediately preceding month, but it is the interest on securities. But here what is given, interest other than interest on securities, so it will be come under the house property or other any other income, so it will be converted at the rate of the last day of the previous year. Is this clear to you? Clear. Okay. Interest other than interest on securities from country Y is US dollar 9,500. Interest becomes due on 1/4/23. Tax deducted on 21/2/24 at US dollar 950 is the tax amount at the rate of 10%. Okay. Agriculture income in country M is 1,09,000. Agriculture is exempt in India, but if it is earned in India from the Indian land, land should be situated in India. But here the agriculture income is from the country M, so it is not going to exempt in India. Okay, it is taxable. Now come on to the additional information. This is going to be very important, so read it very carefully. As per DTAA, which shows that the country N, between India and country N, there exists a DTAA. When the DTAA exists, so we give the bilateral relief under section 90 or 90A. Is this clear to you? Clear. The royalty will only be taxable in the source state. So the resident state does not get the right to tax the royalty income. The DTAA says the royalty income will only be taxable in the source state. So the resident state does not get the power to tax the royalty income. If the resident state does not get the power to tax the royalty income, so there is no question arising for the double taxation. Here the royalty income does not be counted in the double taxed income. Is it clear to you? Clear. As per DTAA, between India and country Y means that country Y also have a DTAA with India. Interest can be taxed in both the states, and the tax credit will be available in respect of the tax payable in the resident state. So the tax payable, the relief of that tax paid will be given by the resident state, and the income, the interest income will get charged in both the states or in both the countries. Okay. Agriculture income is exempt in country M. India does not have a DTAA with country M. So it comes under 91. But it is exempt in country M, only charged in India. So it is also not a double taxed income. Is this clear to you? Clear. Now they are TTBR on different dates of US dollar. Date 31st March 23, 31st January 24, 21st February 24, and 31st March 24. The rate is 75, 85, 79, and 80. You are required to calculate the total income and the tax payable by Mr. Ritesh, assuming that he has opted out of the default tax regime under section 115 BSC. That we have to calculate from the old tax regime only. So this is the whole question. See, this question is very easy if you know how to convert a currency. Okay. See, here it is. Income from business is 4,85,000. Royalty income is 7,80,000. Okay. This is in rupees. Now, interest to be converted at the last day of the previous year, because it is other than interest on securities. Okay. Last day of previous year is 31st March 2024. The rate is 80. Okay. So it needs to be converted at the rate of 80. Then 9,500 multiplied by 80, we get 77,60,000. Okay. Okay. Tax rate also need to be calculated. Tax rate to be converted when the last day of the month immediately preceding month in which the tax has been paid. The tax has been paid on the 21st February 2024. So the previous month is is the January 24 and the last day is 31st. So the rate 31st January 2024 will be applicable at the rate of 78%. So the Mr. Ritesh has paid the tax of rupees 950 multiplied by 78 is equal to 74,000 hundreds. 74,000 rupees the tax has been paid. This is clear. Agriculture income is from country M is 1 lakh 9,000. Is this clear? Now we have to apply the steps. So step number one, income. So let's compute step one. Step one C. The business income is 4,85,000 that we need to charge. Royalty income. Royalty will be taxable in the source state itself. So we do not need to consider this. Remove this. Okay, this need not to be considered. Next come. Interest income. We have calculated 7,60,000. Agriculture income 109. Okay. 4,85,000 plus 7,60,000 plus 109,000 is equal to 1,354,000. See, 1,354,000 is the answer. Is this clear? Step 1 is completed. Completed. We do not get the deductions of anything written here. No, we do not get the deduction. So 13,54,000 is the final answer. Okay. Come on to the step. Step 2 is to calculate the tax. Now we have to calculate the tax on the 13,54,000. So the tax will be 227,448. 227,448. If we round it off the then 227,450 will be the answer. Okay, this is the tax. Let me check 227,450. 227,448 or 450. We have rounded off. Okay, now done. Step number 3. Step number 3. What is the step number 3? See, we have to calculate the average rate of tax in India. Okay. Now, what is the average rate of tax? 227,448 or 450 divided by 13 lakh 54,000 multiplied by 100 is equal to, divided by 13 lakh 54,000 multiplied by 100 is equal to 16.798%. And what is the rate given? What is now we have to check the step number 4, the double tax income. What is the double taxed income? The income which is charged twice. So this is not a double taxed income because it is exempt in country M. Okay, the only interest income is double taxed. So the interest income double tax is 7,60,000 is double tax. Need to be multiplied by step number 3. Let me show it in the other step. As we see, step number 4 we have calculated the double taxed income. Step number 5, compare. We have compared it. Now step number 6, 7,60,000 multiplied by 16.798%. This is the tax which India wants. 7,60,000 multiplied by 16.798%. This is the tax India wants, 127,665. But what he's already paid, 74,110. 74,110. So the deduction will be available lower. The 74,110, the deduction will be available for 74,110 only, which he has already paid. So here from the step number 2, step 2 minus step 6 is equal to step 7. What is the step 2? Answer 227,448 minus 74,110 is equal to 227,448 minus 74,110 is equal to 153338 or 153340 is the final answer. 153340 is the final answer. Let me see. 115350 or 34. Let me check. Got it, got it, got it. It is not 110. 74,100. if we got 74 100 here, so we get here 48, here we get 48, and we get here 50. Okay, 11533 we have matched the answer 153350. Just a mistake of writing down. 741110 is the tax paid in the other country, in the country Y. Is this question clear to you? Question number six. It is an easy question. Okay, let's move forward. See, question number 14 now. Mr. Kamlesh, an individual resident aged 52 years, furnishes you the following particulars of income earned in India, country X and country Y for the previous year 23-24. India has not entered into a DTAA with these two countries. Income from profession is 750. In agriculture income, X is given 50,000. Dividend received from company incorporated Y. The word dividend received is given, but here the gross word is also written by the question. If the question itself says it is a gross figure, so assume it is a gross figure. Do not take it as a net. The question is supreme. If the question says it is a gross, then it is a gross. 1,50,000. Royalty income from a literary book from country X is gross 6 lakh. Expenses on such royalty income is 50,000. Business loss, the proprietary business is 65,000. Come to the note. Note says business loss in country Y not eligible for set off against any other income as per the law of that country. So the country Y does not give the set off provision for the business loss. But in India, it is available. So we consider that business loss as well while computing the total income. Rent from the house situated in country Y, the gross figure is 2,40,000. The municipal taxes paid is 10,000, which is not allowed as deduction in country Y, which we have seen in the earlier question as well. This is the whole question. The tax rate is for X is 10% and for Y is 20% respectively. We have to calculate the total income and the tax payable by Mr. Kamlesh of in India for the assessment year 24-25, assuming that he has opted out of the default tax regime under section 115 BSE. Is this clear to you? The question is clear. The question is very simple. Just we need to follow the step. I'm not solving this question as this question is becomes ultra very important, ultra very easy as we have considered all the points in the earlier example as well. Just a point of business loss is given and the expenses point is given. See, it is from the literary book, so we'll able to give the deduction. Okay, of 3 lakh rupees we can give the deduction. Okay, so what will be the total income? See, 7,50,000 will be the income, part of income. Agriculture income will be the part of income. Dividend income will be the part of income. Royalty income we have to net off. 5,50,000 will be the part of income. Business loss we have to reduce it from the total income. Then the rent from the house property in country Y is 2,30,000, 2,40,000 minus 10,000 of municipal taxes paid is equal to 2,30,000. From where we have to give the standard deduction of 30%. So the final amount comes to 1,61,000. Is this clear? This is the total income. Compute the total income 7,50,000 plus 50,000 plus 1,50,000 plus 5,50,000 plus 1,61,000 minus 65,000 is equal to 15,96,000. It is the gross total income GTI from which we have to give the deductions. Deductions for royalty income. Royalty income is 3 lakhs rupees deduction that we have to give minus 3 lakh, we get the amount of 12,96,000. We get the amount of 12,96,000. Let me write it in the clean area. 12,96,000. Is this clear to you? This is the income. See, this is the income we get 12,96,000. Step number two. What is the step number two? We have to calculate the tax rate, tax paid. So the tax paid is plus 11250 plus 4%. We get the tax step number two. We get the tax of 209,352. See, 209,352. Is it clear to you? Clear. Now, step number three. What is the step number three? We have to calculate the average rate of tax. Now, step number three is equal to 209,352 divided by 1296 multiplied by 100 is equal to We get divided by 12 like 96,000 multiplied by 100. We get 16.154%. 16.154%. It will be 5, as you can see here. It is 16.154%. So here it is a clerical error. You change it to 16.154%. Is it okay? Okay. Now come to step number 4. What is the step number 4? Step number 4 is to calculate the double taxed income. What is the double taxed income? See, agriculture income is a double taxed income. We have also taken the tax on it, and the country X has also taken the tax on it. So the 50,000. Now we have to calculate from the X, because here are two countries. So first we calculating for the X. Country X has also a royalty income. So what will be the royalty income double taxed? See, from the 5,50,000 we have already given the 3 lakh deduction. So we only charge 2,50,000, which is in excess. So here we take 2,50,000 only. Okay, on the portion of 2,50,000 only, the double tax is charged. So we have only taken the 1,60,000 only. So the X is completed. Now there is rest other points are of country Y. So this is 3 lakhs. Okay. Now on this we have to on which we have to calculate what the multiplied by the lower of the rates. So for country X the tax rate is 10%, and we have calculated the Indian tax at 16.154%. So whichever is lower is 10%. So we'll give the relief of section of by the rate of 10%. So here it comes the relief 30,000. Now for country Y. Now for country Y has a rent income of 2,40,000. From that municipal taxes is 10,000. So after deduction of section 24A, we have charged only 1,61,000. So this is the only income which is taxed twice. So 1,61,000. Apart from is from the country Y itself, it is a business loss as well. So we have considered business loss as well. So we need to reduce it from here. Then from country Y, we have also a dividend income, which is a gross income of 1,50,000. Now this is the double tax income. The double tax income is 2,46,000. Now the tax rate of country Y is 20%, and we have calculated the Indian tax rate is 16.154%. So whichever is lower is 16.154% here. 16.154% if we calculate, so we get 39739. So for the relief, and for the relief for country X is 30,000, and the relief for country Y is 39739. So the total relief under step 6, we get a step 6. Yeah, we get a step 6 here. So the total relief for step 6 under step 6 is 69,739. After for that, step number 7, what we do? Step number 2 minus step number 6. What is the step number 2? This is the step number 2. 209,352 minus 69739. 209,352 minus 69739 is get what we get 139,613, or we rounded off 139,610 is the final answer. 139,610. See, 139,610. You get the same answer. Is this clear to you? The question is very easy. Clear to you? Clear. Now moving on to the another question number 15. If you are not getting any of the part, just repeat it and go through it. And if you get any other query, you can ask in the comment section and as well in the Telegram group. I'll available there as well. Now, question number 15. Mr. Raj, aged 45 years. I am not going to solve this question. This question is very easy. The only important point, the only unique point in this question I am talking about. Okay, Mr. Raj, aged 45 years, a resident of India, employed with a private company in India, earned from the earned the following sums during the financial year 23-24. The basic salary DNS allows 10% of the basic salary. So basic salary is 62,000 per month. So we need to multiply it by 12. 62,000 multiplied by 12 is 7,44,000, on which we have to calculate the DNS allowance, which is 10% of the basic salary. So we added the 10% here as well, plus 10%. So we get the 818,400, from where we get the 50,000 standard deduction under salary. So 768,400 is the final figure of the salary. Now all things will repeat. See, royalty income received. Here the gross word is received, so we do not need to take it as net or do it the gross up. The grossing up income is already given. The royalty income of country X in respect of literary books, 9,80,000, expenses 98,000, rental income gross from country N, 2,80,000, dividend from the country N, country N gross is 2,20,000. Dividend is also given the grossed up amount. So we take only 2,20,000. So these are the provision which are the same as we already done. These two lines I have explained you now. See, Mr. Raj purchased a residential house in Bhopal for his residence for a consideration of 23 lakhs and paid 1% of 1% stamp duty on it. So 1% stamp duty on 23 lakhs will become to 23,000. So the deduction of 23,000 can be taken under section 1880C. The stamp duty paid is allowed under section 80C. Okay. He paid 26,000 towards his life insurance premium. He is of 45 years, so the maximum amount which is allowed as deduction is 25,000 only as per section 80D. Okay. And 50,000 to ensure the health of his father, a non-resident aged 72 years, who is not dependent on him. If you remember, under section 80D, the senior citizen, the premium paid for the senior citizens is allowed 50,000 rupees. But here, the father of Mr. Raj is a non-resident. Due to his status non-resident, his premium deduction is restricted to 25,000 only. Okay, so here also we get the 25,000 deduction. Here also 25,000 deduction. So under section 80D, we get the total deduction of 50,000. Okay, the next question is totally same. See, the tax rate of country M is flat 12%. Okay, the tax rate of country N, see this carefully. 20% in respect of dividend income and 15% in respect of the rental income. Okay, country N tax rate is 20% for dividend income and 15% for the rental income. So here we come. Rental income is 15% and dividend income is 20%. So just calculate it. 2,80,000 multiplied by 15% is 42,000, and 2,20,000 multiplied by 20% is 44,000. So here it comes to 86,000. 86,000 tax we have paid on the income of 5 lakh. If we total it, it will come to 5 lakh. So 86,000 tax paid on 5 lakh rupees income multiplied by 100. So average rate of tax for country N will become 86,000 divided by 5 lakh multiplied by 100 is 17.20%. Is this clear to you? We get the average rate of tax for country M. We also country M. We also got the average rate of tax for country N. Is this clear? This questions becomes the same question which we have done earlier as well. The question number 15. The same question is given. Two countries 10 and 20, and here we get the different rates. The rates are 12% and the 17.20%. Is this clear to you? The same question. The question becomes easy now. Assuming does not have a DTAA section 91 deduction, opted out for the default tax regime, so we have to calculate from the old tax regime itself. So this is the very easy question. You can see 7,68,400 we have calculated here. 7,68,400. 196, the 30% deduction. The profits and gain from the literary books 8,82,000. It is from the literary book. So we have also given the royalty income deduction of rupees 3 lakhs. Okay, dividend income, the gross up amount is already given. So we just calculated the 2,20,000. So this is the gross total income. We have deducted the 23,000, the stamp duty value, which we have calculated here, and the 80D 50,000. 80D 50,000. So the total amount of deduction is 3,73,000, and the total income is 16,93,400. I think this is clear. Now the tax is to be calculated. The tax comes to 333,341, and we have to calculate the deduction. Now for the country M, see what we are earning from country M. We are earning a royalty income of 9,80,000 minus 98,000. 9,80,000 minus 98,000 minus 3 lakh. We have also given the deduction of rupees 3 lakh. So the double tax income is only 5,82,000 here. Okay. Country M is completed. Country M flat rate is 12%, and R rate is average rate of tax in India is 19 point is calculated here 19.685%. So the rate of country M is lower, so we'll apply 12% rate. 69,840 is the relief from country M. 69,840 is the relief from country N. Now country N. What we have earned from country N? Country N, we have earned the rental income 2,80,000, and we have also earned the dividend income. Okay. From dividend we have taken the 2,20,000. But from the house property, the rental income, we also have given the standard deduction. So what is the final amount? Final amount is 1,96,000. Okay. 1,96,000. Its total comes to 2,20,000 plus 1,96,000. Total comes to 4,16,000. The tax rate what is applicable? 17.20 or 19.685, whichever is lower is 17.20. 71552. Okay, from country M, and 71552, the total it's to be deducted. The total 141,392 is the total relief that we are going to get. This to be relief, this relief to be deducted from the tax liability. That's step number 2. We get the net tax liability. This is the whole question. I hope this question is clear to you. Okay. Now coming on to the next question. Just a second. Yeah. Now come on to the question number 19. Mr. Chetan, an Indian citizen aged 51 years, left India on 1st April 20 to settle in country Y. But owing to the some personal unavoidable circumstances, he returned back to India permanently on 1st June 2023. This information is given to identify the residential status of Mr. Chetan. See, the Mr. Chetan has left India on 1st April 20. He returned back to India permanently on 1 June 2023. If you know the residential status, the first criteria for becoming the resident is you need to just fulfill the basic condition of 182 days. If you can fulfill the first condition of 182 days or more, you become the resident of the country. So from 1st June 2023 to 31st March 2024, it becomes the one more than 182 days, so he becomes resident here. But to tax his global income, we need to make him a ordinary resident. For not ordinary resident, the global income is not taxable. So firstly we need to make him a ordinary resident. So for making the ordinary resident, the two additional conditions are there. We need to fulfill both. That from out of the 10 previous year, 2 years he should be of residence in India, and second condition is in the last previous 7 years, he must reside for 730 days in India. Okay. If we see from here 23 24, if we go backward for the 10 years, he is only in India. He just left in 2020. So for the 7 years he was a resident in India, 6 to 7 years. So he fulfilled the first condition. 2 out of 10 years he should be resident. He fulfilled the first condition. Second condition is In the last 7 years, he must reside in India for more than 730 days. If he left India in 2020, so he resides in India before that, so he also fulfilled the criteria of 730 days. If we see 7 years back, he has completed his full tenure of 730 days in India. So with this provision, he becomes an ordinary and resident and ordinary resident. With this, his global income is taxed in India. See, here it is given in the negative sense. I have given in the positive sense that he should be resident of 2 out of 10. The wordings of the law is from the negative. They says from the non ordinary resident point of view, if he can be, if that fulfills, so it is a non-resident. If that condition does not fulfill, then he is a ordinary resident. So it is given in the negative sense, but we need to understand from the positive point of view. So we have already discussed the 2 or 10. So just see, hence he become the resident and ordinary resident for the AY 24-25. Accordingly, his global income would be subject to tax. He would, however, be entitled for deduction under Section 91 in respect of the doubly taxed income earned in country Y. Is this clear? Clear. See, now, he has a residential property in country Y from which he earned the rental income of 25,000 for the year ended 31st March 2024. He is eligible for basic exemption limit of dollar 8,000, and on the balance income he had paid the income tax at the rate of 20% in country Y. The tax paid on 10th May 2024 from his bank account in the in India. So the text need to be converted at the rate, you know, at what rate? The last day of the immediately preceding month. Is this clear? His income from business in India is rupees 5 lakh for the year ended on 31st March 2024. He also received dividend amount of rupees 1 lakh 25,000. Now here it is given received. The gross word is not here, so we need to consider it as net. From Indian company, an interest income of rupees 11,500 on saving bank account with SBI during the year. The exchange rate for $1 is given. So the income earned is here. See, the income earned in from the house property. So the house property income need to be converted at the rate of the last day of the previous year. So the last day of the year is 31st March 2024. So the relevant rate is 75. The rest rates are of no use. Okay. Now see, compute the net tax liability of Mr. Chetan in India for the assessment year 24-25 on the assumption that there is no TTAA between India and country Y. See, assume that the assessee opted out of the default tax regime under Section 115 BSC. The question is very similar, very easy. Just we need to calculate the tax rate. See, what is the tax rate? 25,000 minus 8,000 divided by 25,000. This is the total tax paid. This is the total tax paid in country Y, and this is on the total income of $25,000. Multiply by 100, we get the rate. Then 17,000 multiplied by 20% divided by 25,000 multiplied by 100 is 13.6% is the average rate of tax for country Y. Okay, 20% is for this purpose only. We need to calculate the 13.6% as the average rate of tax for country Y. Okay, this provision is done. This provision need to be $25,000 multiplied by 75 is the 18 lakh 75,000 is the income. From here we need to give the 30% deduction. 18 lakh 75,000 minus 30%, we get the 13 lakh 12,500. 13 lakh 12,500. Okay. Then this is done. Business income of rupees 5 lakh. Dividend income 1 lakh 25,000 divided by 90% multiplied by 100 is 13,889. 13,889. Okay. Then the dividend income is, oh sorry, interest income is 11,500. 13 this plus 5 lakh plus 138889 plus 11,500, we get 1962889. From that, we get the deduction of rupees 80 TTA of it under section 80 TTA of rupees 10,000. Any other deduction is not available to him. So the gross total, so the total income becomes 890, 1961890 after the 10,062. 1962 889 minus 10,000 becomes a 52, sorry, 1952 890 is the answer. 1952 890, see, 1952 890. It is clear? Clear. Now we have to calculate the tax on it. Then the same procedure we need to apply. The same thing is to be applied. This is the easiest question. Just I have keep it here is for this calculation only. I have solved this question for this calculation only, that we need to calculate if the rate is 13.6%. Rest question is totally same, and for this resident the calculation of the residential status. Because of these 2 points, I have kept this question in this series. Otherwise, there is no need to calculate no need to solve the question. This is very easy question. The same step needs to be followed. The final answer should be 2,35,800. You need to solve this question by your own. The same question is done. I have calculated the total income. The same step needs to be applied here after. Okay. Now question number 20. Mr. Anil Talpade, aged 62 years, he's a senior citizen now. A resident individual furnishes the following income of in following particulars of income earned by him in India and in Brazil for the previous year 23-24. India does not have a double taxation avoidance agreement with Brazil. See, the question is totally same. Question, you will not find even a single thing in this question different. We have done each and every point. Why I have kept this question? Because of the last line only. Compute the total income and the tax liability of Mr. Amit Talpade for the assessment year 24-25, assuming he wants to be taxed as per the default tax regime under section 115 BAC. Till now, we have opted out from 115 BAC. This is the first question from which we need to calculate the tax as per the 115 BAC. This is only reason I have kept this question. Otherwise, this question is the same question which we are done. See, income from salary, it is computed. So it is computed after that standard deduction. We do not need to do anything. We just take the 4,50,000. Profession income, you know. Dividend income, you know. Rent from house property situated in Brazil, you know. You have to give the 30% deduction from it. Now see, he has opted section 115 BAC, the tax rate under section 115 BAC. So all these points becomes irrelevant. Wait. Interest from interest income of FDR with Bank of Baroda Pune branch is 62,000. It will be included in income, but he is a senior citizen. If you want to give deduction under section 1, under section 80 TTB, so you cannot give that deduction because he has opted for the 115 BAC. So the deduction under these sections will not be available. And these are the deduction point 80C, 80D points. These becomes irrelevant for you now. So this is the whole question till now, till here only. Nothing is new in this question. Just we need to calculate as per the new tax regime. We have to calculate the tax as per the new tax regime. Here you can see these are the rates. Just you have to you are required to calculate according to these regime. That's it. As the question is totally same as you have seen here, all the points we have discussed in earlier question as well. So I am not solving this question. If you want to take the screenshot, or if you want this PDF, it is available in the Telegram channel. You can download it and solve this question number 20. Okay, is this clear to you? Clear. If you get any doubt, if you have any doubt, you can ask me anytime in the comment section or in the group. Okay, now coming on to the question number 21. This is, I think, this is the second last question. After that, we'll wind up the class. Mr. Pravik, 41 years, A sportsman and an individual resident in India furnishes the following particulars of India of income earned in India and from country Y. India does not have a DTAA agreement with country Y. See, same question, nothing is different, just 1 or 2 points. Income from salary computed, okay, we know. Dividend income, we know. Now from country Y. Gift in foreign currency from a friend, exempt in country Y. Exempt in country Y, but it is taxable in India because it is above, over and above the 50,000. In India, we get the limit of 50,000. If we get the if we receive the gift from a friend, we get a deduction of 50,000. If it is lower than 50,000, it will not be taxable. If it is above than 50,000, then the whole amount will get taxable. So this is the unique point in this question. The gift will become the taxable. Then dividend, you know the tax treatment, total tax, total rent, you know the tax treatment, municipal taxes, business laws. We have already computed the business laws. It is not allowed in country Y, but it is allowed in India, so we need to consider this. And the agricultural income, same every point we have discussed earlier, so nothing is new in this question. Country Y does taxes the dividend at the rate of 10% and other income at the rate of 20%. Now you have to calculate the average rate of tax here, as we have done earlier in the earlier question. See, here also need to be calculated as per the 115 BSc. Nothing new in this. Is this clear to you? If you want, I make you solve the country Y average rate of tax. See, now we need to calculate the average rate of tax. See, this is exempt in country Y, so we ignore this. Dividend need to be taxed at the rate of 10%. Dividend at the rate of 10% and other income at the rate of 20%. Total rent 20%. This need not to be considered, as it is not allowed in the country Y. Not allowed in country Y. Not need to consider the agriculture income at the rate of 20%. So what is the total tax? 2,30,000 multiplied by 10%. 3 lakh multiplied by 20%. 2,20,000 multiplied by 20%. 2,20,000 multiplied by 10%. 3 lakh multiplied by 20%, and the 2,20,000 multiplied by 20%. 1,27,000 out of the total income of 230, 3 lakh or 220. That is 450 or 750. Multiply by 100. 16.933% is the average rate of tax. Let me check. 16.933% is the average rate of tax. Now you need to solve this by your own. This is the only question. This is the only point I need to discuss. Otherwise, this question is almost and the same that we have covered till now. All the adjustments are same. Okay, so I'm not solving this question. This is the only point that you need to consider. The 16.933% is the average rate of tax for country Y. Okay, now coming on to the last question of this chapter. See, this is the unique question of the chapter. This needs to be done, but it is a very easy question. Do not get bother about these figures, what are writing in the box. These are very easy. See, Mr. Ram, a citizen of US, resides in St. Joe's in USA since 2004. He is a non-resident since assessment year 2004 and 2005. He is non-resident since he works in X Incorporation, a US-based company. He came to India on 10th January 2023 to visit his aged parents. He could return back on only 31st January 2024. He was permitted to work from home in India by his employer. The details of the earning and will hold in text during the said period as given below. So he could return only by 31st January 2024. So from the 1st April 2023 to 31st January 2024, he completed the 182 days criteria. So he becomes a resident. Since he was not in India from AY 2004 and 5, so he becomes a not ordinary resident, as he will not be able to fulfill the rest of the two conditions. Okay, so he becomes the RNOR. For RNOR, the income which is not accrued or arise in India shall not be taxable. As per section 9, as per section 5, the income which does not accrue or arise to RNOR in India shall not be taxable. Okay, now see, we need to calculate for the assessment year for 24-25, for the previous year 23-24. So for these January 23 on February 23 and March 23 are of no use. Okay. Now coming on to the next paragraph. He has also earned fixed deposit interest in USA on 30th September 2023 US dollar 200, tax deducted US dollar 20, and on 31st March 2024 US dollar 220 is earned, and on that tax deducted is US dollar 22. Okay. Now, as per Article 2 of the DTAA, the taxes covered for the credit of the federal income taxes imposed by the Internal Revenue Code but exceeding the Social Security taxes. So, as per DTAA, the only taxes covered are the federal income taxes. Only taxes which are covered are the federal income taxes. No other taxes are covered as per the DTAA. And it excludes the social security taxes. So, social security taxes are excluded, covers only federal taxes. So, the state taxes are also of no use. So the only portion which are of use is this only. And the tax rate, if you see the exchange rates are also 72 itself. So we assume the exchange rate is 72 only. Okay, this is clear. The salary is to be converted at the last day of the month, immediately preceding month. So it is 72, 6250 multiplied by 72 multiplied by 10 months. It is 10 months, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it is only 10 months. So what will be the salary amount? Is 45 lakhs. Here we get the 50,000 deduction as well. 44 lakh 50,000 is the salary amount. Is this clear to you? The tax will be converted at the rate last day of the previous year. What is the last day of the previous year? It is not given. So the tax, last day of the immediately preceding month. So it is also 72. Then 1600 multiplied by 10 months multiplied by 72 will come to 1600 multiplied by 10 multiplied by 72 is 1152,000. Okay, this is clear. Now, what he have earned. This is the income. He has filed the income or he has filed the tax return on 25th August 2024. What is the time limit to file the return? 31st July 2024. He has filed on August, so it is a belated return. So the question is asking whether there is any interest, fee, fine, anything which will be imposed on Mr. Ram. So this that is why this point is relevant. On the belated return, if you know the interest under section 234 A B C is applicable. Okay. Now compute the tax payable under the default tax regime, and there is a new point. Mr. Ram advise Mr. Ram the procedure involved in to claim the foreign tax credit. To claim the foreign tax credit, you need to give the documents and the procedures that you need to follow. Okay, we'll understand that. So till now we have computed this. The salary income is 44 lakh 50,000, and we also need to do this and the fixed deposit income. So see, but let me check. Let me see. Let me show you a thing. He is also under fixed deposit interest in USA. Interest is received in USA. Tax deducted in USA. Our bank account in USA. Interest received in USA. Tax deducted in USA. Nothing is in India. So this is the income which does not accrue or arise in India. And for RNOR, the income which does not accrue or arise in India shall not get taxable in India. I have made this clear in this portion itself. So this is of no use as this is accrued or arise outside India. So this is of no use. So the question become very easy. Now see 44 lakh 50,000 is the total income. See for he becomes the RNOR. If you see here where it goes, accordingly he becomes the resident but not ordinary resident in India for AY 24-25. Okay. Now 44 lakh 50,000, there is no information for the deduction, and for the interest of fixed deposit in USA shall not also be taxed here, because the income is accrued or received outside India, and for RNOR it does not taken care of. So for the in total income is 44 lakh 50,000, and we calculate as per the new tax regime, as he opted for the section 105 BSE, the total tax becomes the 10 lakh 76,400. The total tax payable in India is 10 lakh 76,400, but he has already paid 11 lakh 52,000 in US. So the deduction, so the relief under section 90, there is a DTAA, so the relief under section 90 will be available for the 10 lakh 76,400, the whole figure. So the net tax payable becomes zero. If the net tax becomes zero, so the interest under section 234 A B C becomes also zero. So there will be no interest, fine, fees on this income. Is this clear to you? See, the foreign tax credit which he can claim would be lower of the following: 11 lakh 52,000 or 10 lakh 76,400, whichever is lower. 10 lakh 16,000, 10 lakh 76,400. So the tax payable would be nil, and no interest under section 234A for the late filing of return. Now see, the following statement of form need to be furnished by Mr. Ram on or before at the end of the relevant assessment year for claiming the TYSA, FTC. A statement of income from US offered to tax for the previous year 23-24, and the US tax deducted or paid on such income in the prescribed form. Certificate of statement specifying the nature of income and the amount of tax deducted therefrom or paid by the assessee from the tax authority of US, or from the person responsible for deduction of tax, or which is signed by the assessee. I can say this is similar like Form 16 in India. Like Form 16 in India, there is some other form in other countries, so it is asking for that. Okay, these are the best, very basic conditions. This is the whole chapter of DTAA. If you have any doubt in any question, you can just rewind the video and watch it again. You will be able to solve each and every question given in this PDF. This PDF can be downloaded from our YouTube or from our Telegram channel. The link is given in the description box as well. Now, before leaving, just take a Snapchat or just take a snapshot of this question. This is the question of May 24, question number 3B. This is the ICI question. You will find this very, very, very easy question, because see, every that point which is given in this question is already discussed by us in the question. See, Mr. Kumar Saurav, a resident Indian, aged 56 year in India and country P, and from country P, his income is given. Indian income, profession, fixed deposit, saving bank. Country P, average rate of tax is given. We do not need to calculate the average rate of tax. Agriculture income is gross, given royalty income and the expenses on that royalty income. Dividend, which is given, dividend given, so it is to be considered as a gross. It is not written dividend received. Dividend is given, that is we considered it as gross. Rent from the house situated in country B, the municipal taxes which is not allowed in country B, we have to give what the 30% deduction. The same, you have to calculate the total income and the net tax liability. Do not have the DTAA. Opted pays tax under the default tax regime. So if it pays the tax under the default tax regime, so the deductions will not be available to him. So this is the question. This is your homework. You need to solve this question and send me the answer either in the comment section or the screenshot of your solved answer in the group. I will check that and make you know if the answer is correct or any improvement is to be considered. Okay, this is all for the session. If you like the session, please do share, like, comment, and subscribe our channel. Share it with your maximum friends so all of them can be benefited from this series. I have launched this series in English as well as per your request. So please take full benefit of this. batch the DT exemption series. If you want to get the DT exemption in November 24, please write it down in the comment section as well that I am going to get the exemption in DT in the November 24 attempt. Okay, so this is all for the session. Let's meet in another session. Till now, do solve all the questions. If you have any query, you can ask me in the comment section or in the group. Till then, let's hope for the best and always study only the 3 months are left for an examination of November 24. So study hard. Avoid all the distractions which distracts you from the study. Just solve all the questions and do studies only. This is all for the day. Let's meet in the another session. Till then, take care.